Appreciate everybody joining us today again, another Thursday afternoon. Today, we're going to deep dive P&Ls. Curious to know who understands a P&L sheet. Just raise your hand. Mike, you're driving, so it's okay. All right. So
I'm
profit and
still
loss.
I'm still learning too, so
There you go. It's a critical component of being a leader in today's business world. If you don't understand the breakdown and the structure of a profit and loss statement sheet, you're already like done. You're done. There's no way that you could lead if you don't understand the data and the results that you're hoping to lead your team to accomplishing. So, what are the concepts? How does it start? What are some of the breakdowns of a P&L? We're going to take you through that today. We're also going to do a team exercise. So, where in the past we've had questions and we open it up, we're going to present a P&L statement. It's fictional, so don't worry about it. Nobody's data is being shown here. And we're going to be able to teach you how to read it, how to talk through it, and how to identify areas of opportunities. So that's going to be the concept for today's tutorial and meeting. So let's get started. Everybody has heard the terms revenue or top line, right? You hear it all the time. What does it mean? What does that line in a general ledger code mean? It's simply what we sell, what you bring in from your products, services, or units that you're selling. So it's all of the revenue coming into your business. And you'll see that represented at the very top line of every profit and loss statement. It's the top section. And we're going to show you how that breaks down. The next lines generally are talking to cost of goods sold. You'll hear it represented as COGS. And this is direct costs that are tied to producing or delivering the service or product that your organization is selling. So it's important that we understand these terminologies because they're the ones that you're going to have to speak to as leaders. The next one is GP or gross profit. Everybody thinks, well, what's the difference between a gross profit and revenue? Shouldn't it be the same? But it's not. Your gross profit is your revenue minus your cost of goods sold. So essentially, it's after you've deducted all those costs that are associated to your service and or product that you're selling. Next comes your operating expenses. So after the operating expenses include your salaries, your rent, anything that's variable, your marketing, your tools. Again, variable expenses means that it fluctuates. It's not always just steady. That's generally your operating expenses. Then you finally get to your net profit line. And what is your net profit? Simply, it's your gross profit subtracting all those expenses that we talked about. That's the line that is critical for you to understand first off, is your net profit. Because from your net profit, you start to really understand some of the larger business tactics that you're going to need to improve and implement in your businesses. Meaning, a tactic that you're going to have to implement is reducing your operating cost. If all of a sudden you start to see that your net profit is not where it needs to be at, but you wouldn't know that unless you understand what each general code ledger is capturing and what it's delivering to you as information. So we're going to go through that mock one in a minute here, but we want to talk about control points. Every team talks about controlling your profit and loss, and they talk about profitability or they talk about revenue. But who manages what? Who impacts what? And it's important for you to know this. Your ops teams, they are a cost center, meaning they're an expense. So their job is to reduce waste, to reduce costs, to make things efficient. In other words, to lower your cost of goods sold, your COGS, or your OP, your operating expenses. That is what your ops team should be focused on. If they're focused on revenue, they're not focused on the things that they are accountable for.
Mm.
Okay. I want to make sure you guys understand that. You can't have an ops team worried about what's being sold. That's not their job. Their job is to ensure that the labor applied to completing the jobs are efficient and reduced. That's it. Or not wasting material, right? If you're in a service industry where you're building something, a bad operating team could be wasting tons of material that are going to increase your material costs. Therefore, it's going to increase your cost of goods sold. So the next one that you need to be aware of is your sales team. Your sales team is tasked with improved pricing, improved upsell, improved growth in revenue. They're also tasked with making sure that not only are they disciplined in pricing, but they're priced right in the market, right? It's not an operations team task to ensure that the price point is correct in the market. That's a sales team function. They need to know, what is my market doing? What are my competitors charging? So therefore, we could be positioned to allow ourselves to grow and or to improve our gross profit by positioning the right price points. The next team that should be monitored and understood of what they own in a P&L statement is your customer service team. And you might be wondering, what does customer service have to do with P&L? With customer service, they own retention and they own ensuring that you're protecting that reoccurring revenue. That's the impact of your customer service team. So now we've talked a little bit about the P&L, the key components as to what are the acronyms and lines you should be looking for. And then we've given you who owns what in that team. But before we go any deeper and talk about P&L levers and the actual P&L, I'll go to Willie and let's talk a little bit about the P&L experience that you've had, Willie, as an entrepreneur and how it was critical for you and your team to really understand a P&L sheet.
Yeah, it going way back when we got started and then we've gone through a couple people at this point where working in our bookkeeping or accounting department, we call it back then. And yes, I did have a simple P&L, but the report was very basic. The revenue wasn't broken down, the costs components weren't broken down. So it really, when it came down to, it wasn't really telling me a whole lot. And since I didn't know much more about it, it was when Hector actually came on board and started questioning, okay, what's all in this item line for costs? And so we need to break it further down. And then we started focusing on building out our P&L report in our system. And I know even back then, we had to even phone the company that sold that system to us to help us build the proper reports that we wanted to have for our operation. And one example is we had multiple branches. So we wanted to now break it down by branches, what the revenue and cost per branch was. And so, yeah, those are a few examples where we had to really overhaul our P&L sheet.
Yeah, that's great, Willie. I'm glad you shared that story and you painted the picture of what's to come next because it's critical that as leaders and as business owners that we understand the profit and loss statement and the activity that goes behind it. Many early entrepreneurs and many leaders leave it to the accountant. They
Mm.
leave it to your bookkeeper. They outsource that activity to somebody else. And it's generally because people don't know it. And because they don't know it, they feel like we're going to hire the expert to manage it for us. But let me tell you something, that bookkeeper and that accountant, they're just compiling your activity and giving you a report of your activity. They're not the ones that's going to fix your performance. They're not going to be the ones that are going to tell you, hey, you need to cut your operating expenses, or you need to go increase your revenue, or you need to do whatever. You need to go lower your rent costs. They're not going to tell you that. They're just giving you the book, they're just giving you the piece of paper. You, my friends, you're the ones that are tasked with knowing that and going and actioning it. So don't leave it to your bookkeeper and your accountant. That's wrong. Their function is to compile the data. Your function is to get results and get it done. So that's why it was really important to hear Willie's story about what it took to go get that true P&L built for his organization and for the need that it was required for everybody to know what was the cost per branch? What was the revenue per branch? What was the activity per department so that we could say, this is a department that's doing well. This is a branch that's doing well. This is one that isn't. And how do we fix that? So
And
that's, go ahead, Will.
yeah, I was just going to add a piece in here. I'm now helping other businesses one-on-one coaching, and what I've come across now a few times is their bookkeeper is remote working with their books, and now there's not proper communication back and forth, even from the operation, what needs to be entered. And so, as I keep pushing them, man, we need better P&L statements. One example of one business last week was yeah, there was a very questionable number on it, and we found out it was a $50,000 mistake entered wrong. And so those are the things I think also where now thinking your bookkeeper will take care of all your numbers, there has to be proper communication back and forth and making sure everything gets entered, right?
Absolutely. Absolutely. And that is so important for every leader to understand. You need to have access to the data, you need to understand the data, and then you need to action it. And you just described it in full cycle there, right? You were able to capture an error and then go get it removed or go get it corrected because it didn't line up with the expectations. But
Luckily, it was for the positive when once that was fixed.
there you go. Now, here's a critical point, right? How is the frequency of when you're reviewing your P&L? Right?
Yeah.
I've said this in several calls in the past, but if you're getting your P&L statement after 30, like longer than 15 days of the month that just passed, you're already way past any point of actioning or impacting the current month and possibly within the next 45 days. So you have to be asking for the information and you have to be seeing it. And this is really important, whether you're a department head or a business owner. You should be asking for that. I'm thinking of Bruce, I'm thinking of Vlad, in Cecilia, in your roles, you should be saying, what's my department P&L? I need to know how my department is doing or how's my business doing generally, and then give me the department breakdowns so that you know what areas you need to focus in. So now let's jump into what are some of those behaviors, right? We talked about now the P&L, you're getting a concept of it. And overall, right, profit is an outcome of daily habits. They're not just because you got lucky or you sold a lot. And again, it's not just because of the leadership decisions that are being made. It's daily habits. Like it's everybody doing the same thing in and out and understanding the pivot points that will allow them to be successful or not. Meaning, an example of a lever, a wasted time. You guys have crews, some of you. I think Mike, you have crews. Vlad, I know you have drivers. Peter, I don't know if you've got crews out there, but let's think of a crew that goes out to a site. Okay. If they show up in the morning, they grab their coffee, they chit chat for 20 minutes with the team while they're on the clock because they're clocked in, right? During they're doing all that activity, that's wasted time before they actually get to the job site to where they start to work. So that it will be a result of higher labor costs. Monitor wasted time. That's a critical one. Another one that generally gets missed in service type businesses, doesn't get captured, is lunch times. You often hear, and I know in the trucking industry, we would hear it a lot in the P&L world. We'd say drivers that say, I didn't take a lunch. And so they would leave themselves clocked in for a lunchtime, but we knew they were off. We knew they were not driving. We knew they took a lunch. But every 30-minute increments for every single driver added up. And so the same could go for any service type industry. You have field staff out there, they're taking their lunches. Monitor that they're in fact clocking out so that you don't incur extra wasted labor costs. So that's something that we should be monitoring. Another one is incorrect orders or failed orders. What does this mean? It's a return of product or service. How many times have we gone back to correct an error because our initial order went wrong? When we do that, it's a zero revenue visit, and it is definitely one that impacts your operating expenses. So it's another line you want to measure. It's another KPI that you want to have eyes on. One that really goes unnoticed because you typically think you're doing it with a goodwill or with the intent to grow is discounts. Discounts lead to lost margin because you're undervaluing your service. So if you're applying too many discounts or too large of a discount, you should be aware of that in your P&L. Remember that if you're providing service that is top notch, don't be afraid to ask to get paid for that. It's not wrong to say, we deliver this type of service, we expect to get compensated for this. Discounts are not a bad thing. There's a time and a place for it, but don't apply it with the same brush just to maintain business or just to gain business, I should say, because then you're really bringing down the quality of your own service. So be mindful of that. There's a time and a place, but that could be one that could hurt you in the long run. Another one is that most people forget to use as a lever is unused capacity or opportunity for triangulation as an example, where you have a driver or a service tech going one direction. What more can we add during that same travel distance, right? If they're already going there, what other work can we connect to that travel activity that we can ensure becomes more profitable for the same distance traveled? So unused capacity is a critical one as well in service, transportation, or anything that's a distribution type of business to be looked at. What other points can you plug in and connect to that? Okay. So these are things that we want to make sure that you understand. And once you know those levers, where can you see them as a KPI for a scorecard? Here's your scorecard touch points that I'd like you guys to walk out with and really start to look at how it ties back to your P&L. As an example, revenue per day. Your revenue per day activity will feed your overall revenue for the month. So you need to know, let's say we have a goal to be at $100,000 of revenue for this month. So we go 100,000 and we divide that by working days, which is 21 working days. Generally, most businesses work 5 days a week. So we're going to say that we have to have a revenue of 4762 per day. And you start to track that every single day. If you're at 4,800, you're in the green. If you're at 4,500, you're in the red. But you know what your revenue per day activity is that will tie back to ensuring you meet your revenue monthly goals. Okay. The next one is labor percent of sales, meaning how much labor did you spend in a percentage per day in sales, so that you're tracking that every single day is another metric, again, that's going to lead to your monthly activities. Material cost percentage. This is a big one for those service industries or construction industries. Your material costs will eat away your profit very quickly, especially if you don't plan ahead and you go and buy materials last minute outside of your regular wholesaler. And now your cost just went way up. Your operating costs and cost of goods went up. Your profit margins went right down. So that's one that I want everybody to monitor. The one that's important as well is your retention rate. You want to monitor that as a KPI so that you're looking for your churn, you're looking for how much of your current retention customers are continuing to spend with you and that they're not leaving you. Because every time they leave and you have to go gain new customers, it's added activity, it's added cost into the system that overall eats away at your operating cost and your cost of goods sold. So those are the KPIs that I wanted to introduce to this group to really monitor on a week-to-week basis, because they're going to really help you, again, be ahead for your monthly expectations. Now we're going to go into the team challenge and we're going to bring up a P&L statement. So Willie, if you wouldn't mind sharing that for us.
Okay, can you see that?
I can now. Can you blow that up a bit?
Should be able to.
There we go. Perfect. This is a good one. All right. That's perfect there, Willie. Yep, that's the whole page. Awesome. Okay, so let's take a look at this P&L. We talked about the terms, right? We had your revenue lines up top. Now, Willie talked about something that was really critical that made the organization that we came from really successful is we were able to break down the types of revenue. So if your organization only shows you one revenue line, you're going to want to see the breakdown. I know in some cases, some of you have various other line items like residential, new construction. In this transportation world, we had flat deck, we had van freight, warehousing, all kinds of different activity that has a revenue line attached to that department or activity. So understand a full breakdown of each is going to be important for you as a leader and as a business owner to know that, because you want to know what is your activity that brings you the most revenue, right? Not the most profitable, the most revenue at this point. And then overall, it will give you your total revenue line. So we could look at the 3-month average here on how it's projecting and how it's moving. And you could see that from February to March, we've had a decrease in revenue outside of, so February we had a decrease of 3%, and then as a change of February to March we had an increase of 4.8%. So it's trending in the right direction if we were looking at it from a March review. Good on the revenue line. Want to make sure everybody sees that, and we can keep going down. The highlighted line items were the ones I wanted to talk about. So there's your operating expenses. That's what this means, that you have included all of your direct labor, all of your fuel, all of your wear and tear items like tires and repairs, parts, and anything that goes into your operating expenses will be captured right below your total revenue line. So that's something that's important for you folks to know. Okay. These are generally variable labor or variable expenses. That's what happens in these categories. So understand them. These are critical for you to pick out as areas of improvement. As an example, fuel's variable, and fuel is one that you can choose to go buy at Petro-Canada or to go buy at Esso. Who gives you a lower rate? Who gives you better prices? So you can impact that by acknowledging your activity and then actioning it, right? So knowing these critical GL codes is going to be important for you as a leader to identify where you can improve. Now let's move down, Willie, and we can go to the next highlighted items. So here we have what would be your administrative costs. You might say, what administrative is? I don't have any like administrative like staff. I don't have a secretary. I don't have admin folks. That's just the terminology. Okay. That's just an accounting term. So I want to make sure you all understand that. Administrative cost means your overhead, your office salaries. Okay. That means the manager salaries generally get bulked into these lines, which means that they're fixed costs. Okay. So anytime you hear administrative, it's generally referring to fixed costs, your rent. Okay. Your salaried staff, your utilities are generally pretty much static. They fluctuate very little. Your insurances. those are pretty consistent for your businesses. They have one monthly payment and it's not going to go up or down as much as you would like to think that it does. Okay. So there's very little outside of these buckets that you can influence or change outside of heavy over what would be those top line salaries. So that overhead salary piece. Okay. Your rent, sure, you could adjust that by moving into a cheaper space, but that's a really hard one to do. So I don't really foresee that a lot of leaders, especially as business leaders and department heads, you're not going to have much influence in some of these line items outside of those salaries that report to you. Okay. So as you keep going down, Willie, you're going to see the next highlighted line will be your total operating expenses. This calls it overhead expenses, but it's essentially your total operating expenses. Once you subtract all of that activity, you'll land into operating income. This is generally what people will look at as your first line. That's where your eyes will go to, and you'll say, okay, after all of our expenses, how did we do? Did we make money or did we lose money? Okay. In this P&L, we see that January was healthy. We saw a big dip in February and then a bounce back month here in March. Overall, it looks like we're doing okay. Like we're not horrible in the 3 month average, but we're not doing great because of that February dip. And so we're going to want to understand what happened in February shortly. The next line that I want to talk about is one that most leaders and most owners don't understand. And I'll let Willie share his story on this line, and it's the EBITDA line. Who in this room understands EBITDA and what EBITDA represents in a business and as a P&L? Just by show of hands. No, no. Peter's saying no. Vlad's saying no. Mike's, I don't know if he can hear me. Cecilia. Yeah, Cecilia knows EBITDA. Willie, what has been your experience with the EBITDA line?
Yeah, that's something that I found out is, again, coming back to you, you were pointing that out to me where you really needed the EBITDA line to be on our P&L statement in order to manage the operation better. And also the EBITDA line was a very important line for us to structure a bonus structure against for our employees is what we banked it off as well. But then the most important thing is where I found out when people are looking at your business, the EBITDA line is what they want to see and value your business on and what the business is actually worth.
That's right. It is the health status of your business. And this stands for EBITDA stands for earnings before interest, taxes, depreciation. Okay. That is what the EBITDA line stands for. And what it'll capture is all of those activities that will tell investors that your business is healthy. And as a rule of thumb, I will tell you this, a 10% EBITDA or below, say you're landing at 10%, it means that your business is staying afloat. It's okay. Anything from 0 to 5, you're not healthy. You're in fact in financial trouble and you're just making it by, meaning that you might have cash flow issues. You might not have money to be able to reinvest back into the business for new equipment, new materials, and or salaries, bonuses, all that stuff that Willie's outlined. Your business cannot structure any of those programs. 10%, you could probably get away with it. You'll be healthy enough to sustain it. As a rule of thumb, anything from 15 and above is where you want to be. 15 to 25, you're doing very well. You're healthy. You have money to reinvest and to grow your business from an organic standpoint. 25 and more, you're really cooking. You're able to pick up some really good money to be able to maybe do an acquisition, maybe two, who knows. But now you've got some sustainability income in your business that will certainly allow you to grow. So, EBITDA, if you take anything out of today's call, learn EBITDA, learn the percentages, learn the value of it, and learn what makes up the EBITDA amount. And so this key number for us, as Willie outlined, was the turning point of focus for us. We couldn't go provide bonuses for our team if we didn't hit 15% EBITDA every single quarter. We just couldn't, because we meant that we were not financially healthy. We had not been financially responsible in the previous quarter to be able to give out those bonuses. So important for us to know as leaders on how do we manage that? What sort of things that we want to look for? So variable labor, hard-coded labor costs, like static labor costs, material costs, fuel, any of those line items, you want to monitor your KPIs, your revenue per day, your material costs, all the stuff that we talked about earlier, so that you know that your EBITDA at the end of the month and at the end of the quarter will be healthy and that your business is sustainable. So in this line item review, we could see that if we go up to the top, Willie, we had revenue lines at 4.1 million, right? For January as an example, 4.1 million, and our EBITDA ended up resulting in $388,000. Not too bad. That's a pretty decent EBITDA result. When we look at the month before, though, we had $76,000 EBITDA. That's a substantial dip. And we look at February, and the same type of revenue line, 4 million, we had about $100,000 difference in revenue, but a significant dip in EBITDA. So I'd be questioning, like, what drove that number? What happened during this month that made that occur? And after EBITDA is, of course, your net profit. This is your next line. This is your very last line. This is how much money actually went to the bank account when the month closed. And so your net income is really important. Obviously, you goes without saying, you want to have a profit, you want to have a positive number. Anything with a negative is not great. It's not good. You need to start actioning it once it gets negative. So if we look at January in this result, we had a net income of $120,000 in January, negative $213,000 income in February, and then a bounce back at a positive $156,000 in March. This shows to me a profit percentage of 2.9% in January, a loss of 5.3% in February, and then 3.7. So well below a 10% line, right? Or 10% where we want to be at in the net profit piece. This company needs some work. I think there's an issue in February. And as a team exercise, I want us to focus on February. Let's look at what went wrong in this company in February. So you can feel free to unmute yourselves. Let's look at this spreadsheet as a group and let's talk through it. This is an opportunity to learn and to get hands-on experience from a P&L perspective.
Yeah, first of all, revenue dipped. So that's one part of the problem. But then
Yep.
the next step.
We see that we had 100,000 or in change that was lower, right?
So
What else do we
salaries
see?
increase 191 instead of 185.
Your what increase? Sorry.
Salaries,
Oh,
office and
salaries.
admin
Yep.
staff. Yeah.
Yep. Definitely your salaries increased. We see something else that's variable that increased.
Looks like tires and repairs,
Yeah, and insurance.
fuel.
Yep. Your fuel, your cost. So interesting. Let's talk about that. So we had less revenue, right? We had $100,000 less revenue. Why did we burn more fuel?
It
Weather.
was cold February, probably.
Why did we burn more fuel? What happened with the tires and repairs? How did it increase? Not significantly, but there was a bit of an increase, 30 grand. Did we have a major repair? Did we have one engine that blew and that all of a sudden we had to do an engine job? But why did we spend more labor when we had less revenue? That would be my first question asked to the team that I manage. I'd be like, help me understand what happened. How did we make less money, meaning that we were less busy, but yet we spent more on labor, we spent more on fuel. So did we maintain the same amount of headcount, or did we shrink based on our less volume of activity? My gut in this document tells me, no, we didn't. We, in fact, continued with the same behaviors and probably acted not as diligent as we should have. Anybody else see anything else?
My question would be, why did the insurance go up for February?
Good point. It could be a renewal. It could be an incident that could have happened. It was certainly a bit of a blip. Generally, maybe you added more equipment. As you add more equipment, your insurance would go up, right? Because your policy changes.
In the repair side, it's something that I've experienced many times where, man, why did we spend so much this month on repairs? And I know when we started deep diving the cost of our repairs, we were finding that our shops were making decisions on their own, which weren't the best decisions, where they would outsource a bunch of work because they thought things were urgent and rushed, or there were some big bills from outside of our business that came in, and then we would assess and say, was this actually needed or required? And I know, Hector, we ended up cutting our repairs down by thousands of dollars. I think once we had a clear tracking in place where I think we cut our costs down by 50 grand a month in our repair costs, right?
Yeah, absolutely. A big one was bringing in the ability to do government inspections in-house. We were outsourcing in the trucking world, we call them CVIPs for the commercial inspections. And those can get very expensive. But once we get our own people certified in our shop, we were able to do that in-house, bringing that cost down. Thinking of ways to manage the cost is what we do as leaders. But once you have the data, now it's your job to go get creative and manage that cost down, right? So I would look at this and say, okay, fuel, completely unacceptable. How did we have our fuel go up on a month where we had less activity? We needed to manage that better. Let's go find out what happened. Who was idling? Who was driving more than they should have been? Or what happened during that month? Okay. So that's the top line activities. Let's go into our administrative expenses. Let's see what happened here, Willie.
And what I would like to point out here is again, where I have experienced this in my own business where we weren't reviewing these P&Ls on a monthly basis. And your gut feel was saying, I think we had a pretty good month. But here again, we this loss in February, if you didn't have this report, you would never know, or until later on trying to figure out why there was such a big loss, right?
Yeah, absolutely. And that's generally because department leaders and business owners are guided by activity, their sense of activity, right? If there's a lot of people moving and a lot of sales related activity or revenue activity, you believe that you're doing the right thing and that the other numbers will take care of themselves. And as we all know, I don't want to get political, but we all have had a prime minister that said budgets balance themselves. And that's not necessarily true, right? Like P&Ls don't take care of themselves. We have to manage them. We have to see the activity, and then we have to take the corrective course in order to do so. Timeliness is very important. You have to see it within the right timeline so that you can impact it. Now we look at our overhead expenses again. These are those administrative costs. They're mostly fixed expenses. So what happened in January for these? They're generally fixed. So what do we see in these line items?
Salaries went up in the office.
Salaries went up. Yeah.
That could be a severance paid.
It could be a severance pay. We probably terminated somebody and we had to pay them out their severance. Yep. Could be. Absolutely. Right. What's interesting is depreciation went up a little bit here.
Yeah.
So depreciation is generally a dollar amount that goes into your assets. So we depreciated some more of our assets that month, which cost us a little bit more. Maybe it was the wrong month to add new equipment. Given that our volume of revenue came down, probably not the best time to be adding some new equipment. Possibly. Continue to go down, Willie. Generally, again, these are still part of that overhead expenses or administrative costs. They're generally pretty flat and don't fluctuate all too much. But look at this. There's one item that did by quite a bit.
Interest.
Interest expenses. And what else went up earlier? Went up, started with a D?
Depreciation.
Depreciation, right? So this paints a clear picture for us as leaders. This tells us now that there was certainly new equipment that was added in that month because we took on some more interest, right? We must have gotten some new equipment that came with a new loan that now cost us a little bit more money on that interest expenses.
And that will be related to the insurance increase as well.
That would be related to the insurance increases as well. Now you're seeing it, right? So we added more bodies, we added more equipment on a month that our revenue dipped. So what happened? Did we plan? Maybe not, but it's something that we need to be aware of as leaders as we do this exercise, right? Now we get down to our EBITDA. It took a dive, huge dive. Now, our operating expenses, of course, did the same. And then our net profit hit red number. So overall, when we see all that activity, it tells us that we had several decisions that we needed to manage a lot better. Our field labor was not managed. Our cost of fuel and our variable expenses were not managed. And then on top of that, we added extra operating expenses into our business for a month that took a dip. Were we preparing for an increase? And then we go back up, Willie, back up to March, to our bounce back month that showed an increase of an extra $200,000. Was it in preparation for that? That we knew we were going to have additional business, so we needed to go get the equipment? Potentially. I think that's the way I would see this if I'm looking at the trend here in a 3-month picture. But it tells me then, it solidifies that the decision to add equipment was good because we were going to need the extra equipment for the revenue. It was the variable labor in February we needed to manage. That's why we lost money. The equipment and everything that came with it was just timing for the additional growth, which we can absorb, we can explain, and we can move on. That's fine. It happens in business. However, that variable labor piece and not managing it when we knew we were going to have lower revenue is where I would question our team and hold accountability behind it. If we know that we're going to go into a dip into our business, and it could be seasonal, it could be for XYZ reasons, we lost a big account, then we need to pivot and squeeze our labor to adjust to the loss or to the shrink in volume that we're expecting at the same time. And that means we need to act quick. Data has to be at your fingertips, because if it's not, you're not going to react fast enough, and you're going to end up like these people did and spending more labor than they should have.
But don't you have to think about retaining guys too, and knowing that they're just not easy to come by, especially in like my markets right now. Very hard to find employees, and we know when we have dips. We just went through this the past 3 months. We knew we were going to go into a dip. We knew we were going to spend more money on these guys, but we had to retain them because we knew what was coming on the other side. And now we're still looking for more guys. And thank God we didn't get rid of these guys and we retained them at our cost, but we knew that would benefit us in the long run.
Yeah. And that's a business decision, Mike, and you can certainly go that route. You just have to know that it's planned and that it's short-term pain. Okay. You can't allow that to be a year-long strategy, or you're going to be in some serious financial trouble by the end of it. But if you say, look, I know organizations that say, look, I'm going to carry this extra bodies through the winter because I'm going to really need them from the spring onwards, right?
Yeah.
So from November, December, January, I'm going to be extremely overstaffed, but I'm going to carry them. It's a business decision. That's fine. You could carry
Fine.
the labor, but then you should be looking at other expenses to shrink. If
Shrink.
you
Okay.
And
so if you're going to carry the labor, make sure that you're not spending more on fuel during those months. Make sure that you're also not incurring more insurance costs in your injuries, as an example, WCB costs.
Yeah.
Make sure that your material costs are under control during that time of period. So just because one general ledger number has to stay flat or increase doesn't mean the rest have to follow suit. Look to see where you can decrease there as well.
Yep, that makes
and
sense.
one thing I would like to mention here, I know back when we looked at our labor costs from a daily standpoint, where Hector, you implemented a rotation program where people were off on rotation, or each week somebody had to volunteer, for an example, at the Grand Prairie branch to be off if there wasn't enough work. And that actually worked way better than I thought it would. It almost was like people were coming forward saying, I'm okay being off this week if you don't need me. And all of a sudden, we had that working like clockwork, where if we didn't need the labor, we didn't have to feel bad sending them home. And
Yeah, absolutely. I think
sometimes
Yeah.
I think it's just communicating that we don't really need you, but we want to keep on, hold on, but how can we come up with a plan together around that?
yeah,
Yeah. Work with them.
oh, go ahead, Mike. Sorry.
No, we do the same thing. We call it short time. So we'll work with them because they're still getting paid more than if they have to go on EI. If they're
Yeah,
short timing with us, they're still getting a bigger paycheck at the end of the day.
yeah.
Yeah, absolutely. Like job sharing programs is generally what these would be called. And you want to make sure that you're transparent with everybody. It's look, this is a small window of time that we need to do this, but it'll ensure that you have full-time status back in the busy season. And so
Yeah.
we're going to want to make sure that we do the best for the organization and bring everybody in during that time. But for now, we're going to rotate it. And who's willing to stay home, take volunteers, and then go that the easy route is that. The harder route is when you're going to have to start to select people as to who gets parked and who goes to work instead of those programs. And generally, it is the last person to join the organization or lowest seniority folks that are generally parked, right? And that is in unionized or non-unionized businesses, they follow the same protocols.
Yeah.
Okay. So what other learnings, what are some of the other highlights from going through this review that each of you saw here today? Or what questions do you have about a P&L that you might want us to help you with?
I don't have a question, but I just have a comment. In a lot of other places that I work for, that they're not used to share that with admin staff, or I think it's important that that is shared with the employees, because yeah, it gives you an idea of the value of the work that you're doing, where to put your efforts towards. Do we need, like you said, this month we need to make sure we save, or we need to cut on cost, or it gives you an idea of the purpose of what you're doing, what it means, and it keeps you motivated. And especially when you work in a company that has different branches, it almost creates like a healthy, what's the word I want to use? Yeah, not competition, but yeah, you know what I mean? It's just trying to be better. Okay, yeah, our team can comparing the different teams. It's good. It's a way to keep people motivated.
Absolutely, it is. Mao, I'll tell you the biggest challenge to why I've seen in my career that these data points are not shared with department leaders. And it's because the majority of businesses are privately held. And the entrepreneur, the business owner, doesn't want this data out there for fear that people use it the wrong way or come up with beliefs that are not right, meaning, oh, they know how much money we're making, therefore it will align with how much money they're paying us and wages. And that is a very old school mentality, but unfortunately it's the truth. It is out there. So what I generally tell entrepreneurs is you don't have to give the number, but give a percentage. Give some data. Give something that leads the information to be actionable so that people know if we're doing good or if we're doing bad. And that's what I would encourage for all of you in your day-to-day jobs and what you're or in your businesses. Try to provide some level of information to your department head so that they can make the right decisions. And as far as the competition comments, I think that's a great one. I don't shy away from it. I know that where we're at today, at where we work, we haven't yet done that, but it is on the path of where I want to build it to. It's coming. It's being built. It's behind the scenes right now. And soon enough, just like there was at Willie's Trucking, there will be a Edmonton activity report. There will be a Northern Alberta report. There will be a Southern Alberta report so that we know revenue per zone, we know expenses per zone, and then ultimately profitability and EBITDA per zone so that we can see, yep, this group's making the right decisions or this group's not making the right decisions. And the same for all the businesses that are here today.
Yeah, and I was gonna comment, and then the teams can actually learn from each other. So you might have a team that is really strong in the revenue portion, but then not so good on the cost, of course. And yeah, the teams can learn from each other for sure.
Absolutely. That definitely. Just because you're the higher earning team doesn't mean you're winning.
Yeah.
That's not it. Just because you're bringing, you have, if you're not managing your expenses and your EBITDA is not strong, then you're not, what are you doing it for? We can all remember the Willie story, right? Willie's Trucking. It was, what was it, making Willie $18 million and losing $1 million or something? Okay.
1.3 million that year.
1.3 million. Yeah. So it's not, the game's not won on on the top line revenue line. The game is won at the bottom. And that means that you have to monitor all the activity that goes in between that P&L statement. So that's what we discussed today. What other questions, Peter? Yeah, maybe you haven't really chatted too much today. What's on your mind?
No, there's too much EBITDA and P&L for me. I don't have a whole lot, so this is just good stuff for to learn from me. So I appreciate it.
Awesome. Awesome.
The-
Vlad, what about you? What are some of the takeaways or questions that you might have for us today?
Yeah, it just reminded myself how we told our drivers to take extra vacation in the summer. We made it positive. We told them like, yeah, work is slow, and and we encouraged them to take vacations. And now we are going through not seating a lot of drivers because of that as well. So
Yeah.
yeah, and it was really positive experience with them.
Excellent. And I'm excited to be able to bring more of this to the team and so that we as leaders grow and we learn how to really look out for these key components in businesses because it's not just about the day-to-day stuff, right? Like that stuff is going to be there, but it's also the month activities. We need to know what does that report look like and what is my focus point for the next month. That's the last point I wanted to make on a P&L statement. Just because the month closed and you saw that bottom number doesn't mean it stops there. It actually is the starting point for you to focus on ahead and into the future. So that's my last talking point is use it as your planning tool. Understand the historical activity and now use it as what am I going to forecast for next month? Where do we need to be at in 1 to 2 to 3 months ahead? Is my volume, is my revenue going to increase? By how much should my overall headcount increase to help support that revenue? Am I going to need one more asset, two, three, four? How many more assets am I going to need with that revenue? Or is it going to go down? So use it as your planning tool. Do not stop just because the month ended, close the book and forget about it and go back. No, now go and use it as your planning. That's the way that good leaders are able to stay ahead of activity waves and able to outperform those ones that don't plan and they're caught in that storm of activity. Does that make sense for the group? Yeah.
Very good. And
Willie,
I
any
was,
final thoughts?
yeah, I was looking for a book that I once read about sharing numbers with your employees, and I couldn't find it here right now, but once I do, I'll share it in the community. And that book
Awesome.
talked about, yeah, how every business should share a P&L statement with employees. And yeah, it talked about maybe not all the numbers, but some key numbers. And the other thing it talked about was that most employees, if you go to all of your employees and ask them this question, how much money percentage wise do you think is left over at the end of month? And the book talked about where average over or like 80% of your employees will say over 50%. Like they have no idea what the percentage the company usually makes. And so if you start sharing your P&L statements, they will actually be shocked the other way instead of saying, "Oh man, the company is making so much money."
Mm-hmm.
And I really thought that book, every business owner, leader should read it and understand and not be so shy to share some numbers.
Yeah, I agree with you. I know it's a tough one. And I always believe that we should be transparent and ask our folks to really help grow as individuals. And they'll know, the only way they're going to do that is if they're empowered by the data.
Yeah. We're 3 minutes over, so I think we'll call it good for today.
Awesome. Thanks, folks. Appreciate everybody joining tonight. Enjoy the rest of your week, and we will talk to you later.